All right, folks, here we are back on Trading Nut. We've got Steve Ruffley here with us again. We're doing a series of Q&As from the audience. So today is all about correlation. There's only one question, sort of two, but we're going to get a screen share going on here so Steve can really go into this in detail. So Steve, welcome back to the show.
Thank you.
So let's jump into this. So the question is, what specific correlations do you look for between the markets you trade? And can we see some examples on the charts? So I don't know if you want to jump into the chart straight away and we can walk through this stuff.
Yep.
Hey folks, my sponsors City Traders Imperium have just launched some amazing changes to their funded trader program you got to check out. You can now skip the whole evaluation, trade gold as well as Forex, plus they've increased the drawdown you're allowed in both the evaluation and when funded. With C2A, it's even faster and easier to reach up to $4 million in funding with a 50 to 70% profit share. Click the link in the description to find out what else has changed.
This is the kind of the screen that I've used for a long time. Can you see this now?
Yeah.
Yeah. So it's my kind of window to the world. Anything that's kind of, moving, this is what I want to be focusing on. So, I mean, it's a very kind of simple idea. You've got your stocks here. So we've got the NASDAQ and the DAX. DAX is what I primarily trade. So that's kind of in my top left, so I've got that kind of, eyesight. Because again, a lot of things I do, quite visual and, I'm quite triggered by types of movement. Then we've got gold. So obviously the natural correlation between the stocks here is that, stocks go down, gold goes up. That's your basic safe haven view of the markets. Then got the euro dollar here, dollar yen and cable, and then the FTSE down here. And that really, it is a way of drawing your eye from one extreme to the other. So the dollar for me, dollar yen is my preferred choice of trading the dollar. Now, the dollar is obviously going to be the world currency, remain the world currency until, Bitcoin or the digital renminbi or something takes off. Who knows? Whatever. I mean, that's all by the by. For now, let's stick with the real world and what kind of moves the markets. The dollar, we all know the dollar's, king. It's seen as a safe haven in times of, kind of unrest, which I guess we're in, very clear time of unrest at the minute in the world economically. But the trouble is, without going into an economics lesson or a fundamental lesson, we're in this big battle between man-made inflation. Who'd have thought printing trillions of dollars would have led to inflation? And that was a bit of a no-brainer, wasn't it? So it's kind of what we're looking for at the minute is to figure out with these 8 products how the world is feeling about growth. And remember, we all talk about these big growth numbers, but they're backed by terrible growth numbers after the pandemic hit. So we're only just getting back to normal with these overinflated growth figures. Then we're talking about inflation, which naturally leads on to the old-fashioned way of controlling inflation was rates. Is this the same? Can we still really control the inflation, the type of inflation we have with rates? Don't know. An interesting one. Probably a question for another time. So we're looking at the dollar direction. Is that based on safe haven? Is it based on growth? Is it based on inflation? Expectation for interest rates? Don't know. Doesn't really matter. With correlations, that if the dollar goes up, gold should go down, because gold becomes more expensive traditionally. But again, is that safe haven linked or inflationary linked? So it's all about knowing the cycle that you're trying to interpret. And that's very tricky at the minute because we're not in a traditional growth or inflationary cycle. We're in a COVID, man-made, we're all going to die, type situation when nobody knows apart from the experts that are making all the money. Because let's face it, it's only the rich that are benefiting from the pandemic. And, that's just the way of life, I'm afraid. So for me personally, I'm seeing the dollar as a buy. It's always been a buy low, and that's just through my technical reasons. I still think it's relatively cheap at the minute, and that kind of leads me on to thinking when this rallies, then the natural correlation will be the euro to drop lower. Now, the euro is keeping its interest rates low for a very long time, negative deposit rates still, and, they have the lower inflation kind of expectations, I guess, against the US and the UK, but, still have their problems. You can't keep interest rates low forever. But as a short-term trader, not somebody who's trying to be right and say, the market's going to get to here and get to here, that makes any difference to me. What I'm looking for is the market to spike to these levels of interest here and get involved for short periods of time, generally in the 5 or 15-minute charts, and sell it high and be able to buy it back low. So as I said to you before, I never buy the euro. I will only sell it high. I will never buy the gold, for instance. I will always sell it high. I buy the low in pound. I buy the dips in stocks. except when it's a big kind of, fundamental change in the markets or something new happens. So really, by looking at these 8 products, you're looking at the major currencies, you're looking at the stocks and gold. So what really you have to figure out in your head is, why is the market moving? So it's either that growth scenario, where I think that we're kind of past that. Growth has been man-made. It's by being quantitative easing, ultra-low rates. It's by the central banks encouraging growth. So we're coming towards the end of that. So the hangover from that is, where does the growth come from? And what do we do about the inflationary pressures that have been caused? So this, again, where it becomes very difficult, because traditionally gold is a protection against inflation. But then we've seen people move into digital currencies, NFTs, etc. Basically, everything's gone up, hasn't it? Everything we've bought has gone up. So for me, I'm still happier selling gold, because I think that's quite an old-fashioned way of looking at an inflation hedge. And I think that the strength that I'm going to see in the dollar will make gold less attractive. We're still at the lows in stocks at the minute. Again, sell them at your peril, but buying the dip has worked for 10 years. So that kind of correlated. If I see stocks hitting the bottom, we've got the 423, Fibonacci hit in the DAX and the S&P, the FTSE here. So if we're seeing a little bit of a bottom, and we see the dollar yen go up, because again, this is pretty mid-range. It's been ranging, but if it does break up and the currencies go lower, that might be the target to sell gold. And again, I'm not looking to sell gold down to the fib levels. I'll be looking for it to break these bottoms, maybe get to the 50%, break the Bollinger Band, because I'm only looking for those 10, 20, 30 pips. So again, generally I like to do the opposite. So I'd be selling gold as it went up, and then I'd be making my money here. And then if you hold it for too long, you get stopped out. And the gold goes down, and it gets to here, and it gets to here, and it gets to here. But that's not the style of trader I am. So I'm trying to get in the position. So I don't know I'd necessarily, unless we saw the stock start to significantly bounce up, and the dollar ramp. That might be just a market trade where you get in very quickly, and you don't get the chance to kind of maybe average as aggressively as I normally would do, because I'm going with the trend. So I might only get a couple of clips off, break these bottoms, get another one, then try and get it back out here before it invariably bounce back. So that's the big difference between, scaling into a product, based upon where nothing's happened. So this is the great thing about trading, is all the money's made, isn't it, in the right of the screen, in this blank. But the less you see, the more money you can make, because this can go to as red as you like, as quick as you like. But that is the future. It's not known. If this is a big red candle, any muppet could buy it here. But then you've seen it. You're not going to get a full retracement back to here. You're probably going to get less. So the more information you see on the screen, the less you get out of it. And that has to kind of really kind of filter into your trading kind of strategy. So the more you don't see, I'm trying to predict what the future is, trying to do my aggressive averages, waiting for the bounce, knowing where the market could go. And some people might say, well, if you know it's going to go down to here, Steve, then you should sell it. But as I've said, I can't change the way I feel about certain products. I can't change the way I feel about the way I think correlations work. So I would rather sell gold high, rather than, kind of do a selling gold and look to buy it back here for, kind of a big pipper gain. I'm not interested necessarily in being right. I'm being interested in putting my size in, getting my trades out, and banking the money. And I know people don't understand that, but when you spoke to as many traders as I have, and I used to run the trading floor at Snyder's, had 140 traders. I've risked some of the biggest traders, and your arrogance. When I was a risk manager, I said to one guy, and I was just like, if you just did the opposite of what you did, you make that much more money. It's like, all right, Steve, very good, yeah, but that's why you're in risk, and I'm the trader. I make my money, yeah, and I make it every day, and that's what works for me. I don't care what the next guy does. Yeah, because that's none of my business. What I care about is making my money, and I know how I make it. And that kind of resonated with me. It's kind of like everyone's there, aren't they, with their opinion or trying to put the 2 cents in. It's like, at the end of the day, what does it matter? This is what people get confused about. If I read this book, or I listened to this podcast, or I paid 10 grand for this course, I'd just be a better trader. People don't want to own up to what makes a good trader. It's being honest with yourself, understanding how the markets make you feel, and interacting with the markets in a way you can consistently make money. And that takes time and effort. And people don't necessarily want to put the time and effort in. They want that shortcut. And I'm not saying that, my mentoring or talking to somebody who's been there and done it can't help you fill in those gaps, but it's you that has to, do the difficult things. And if you don't do the difficult things, you'll never get the rewards.
Now, just to back onto the correlation. I mean, if I
Yeah.
if I said, right, let's take away 7 of these charts and just leave you with DAX.
Yep.
How would you feel from a like, I suppose, information sort of void? Would you be feeling like, oh, I don't feel confident in this now that you haven't got the correlation view? Would you be like sort of, does that sort of change everything for you, or do you sort of like think, well, I can still trade this, but I'm just not going to be as confident once I'm in a trade, or it's going to, how does that sort of affect you?
No, it's a very good point. Very good question. I mean, the charts are the charts. So, I mean, generally, if I'm looking at one chart individually, which doesn't happen very often, and you have to remember, I trade more like a prop trader. So I'm trading markets as they're moving. Okay, so I'm looking at all those 8 markets, and one correlation might trigger something in another market that hasn't quite happened yet, and I want to get involved in that market. If I want to just see what the DAX is going to do, I start the same way. Monthly chart. Okay, what's been happening? They bought it. Weekly chart. What's been happening? Yeah, everyone's bought it. Daily chart. Bit of a sell-off, bit of a gap. Looked like it was really going to get, below these levels and hit back. No, they bought it. So, okay, what's going to happen on the hourly chart? Well, at some point, they're going to buy it. So is this low? Is this value? Well, yeah, we're towards the low value, but it doesn't necessarily mean this is the value here. What I'd be looking for is a fast, aggressive move to break the Bollinger Bands down to here, maybe average all the way down to here and close that gap, and then look for a bounce. So if I'm looking for a DAX trade to go long in, because that's the obvious trade, because that's what's worked from every time frame monthly downwards, is you're looking for that market to hit low value and to bounce back. So again, I'm not looking to sell it high and buy it low. I'm looking for the market to be low, me to find a point of value and attraction, and then get involved at the nearest point I can, average in my size, and then get that bounce. Because the market can do this. It can bounce, I'm out. Then it can do that, I'd be killed. Market does this, it bounces, I'm out. Does that, I'm killed. That's account gone. Because if you try and hold things against the market with size, it no matter how big your account is, you're going to get hurt. So it's like, yeah, but you could sell it like that, and it goes all the way down here. That might happen once every year, once every couple of years, and then it bounces all the way back, because that's what the charts have told you. I'm going with a percentage trade, and that's why I go back to the correlations. I dip buy. I buy the stocks low because that's what's worked. I sell gold high because the stocks are going up. I buy the dollar low because it's a world currency, and when the euro's high, I sell it because I don't really believe in the EU as an entity. And their policy, so I'd sell that high, and I buy dips in the pound because I have a lot of pounds. I'm from the UK, I still have a lot of money in pounds, so I'm just basically buying free money. So yeah, I mean, that's how these correlations work, and it's not necessarily what you're seeing and what's happening, because that's again predicting the future and the direction. Sometimes you can see a spike in one thing, and you think, right, well, dollar's going high, so what does that mean? Do I sell gold, or do I sell the euro, or do I sell the pound, or do I do all three? You can do anything you want. Something as a correlation can be a trigger, or it can be a warning something else is going to happen.
Hey guys, ever wonder what broker I use? Well, I use these guys, Hanko Trade. Look, it was a no-brainer for me because I was looking for a broker with really good trading conditions and one without any leverage restrictions. Look, also, by joining Hanko Trade, I was able to cut my cost of trading significantly with their super low commission of $1 per 100K. Look, if you want to find out more, check out hankotrade.com, or there is a link in the description.
Cool. Awesome. Well, look, Steve, thank you once again for sharing with us around correlation this time. Next time, we're going to start talking about your strategy. So, guys, stay tuned for that. But before we wrap up, what's the best way for the guys to get hold of you?
Yeah, as always, just Google me, Steve Ruffley. There's plenty of pages on Google. You can check me out on my YouTube channel. Everything Steve Ruffley. So, as I say, email, if you want to contact me directly, steve@steveruffley.com. Or generally kind of hang out on Twitter at Steve Ruffley. So, yeah, Google's your best bet. Just tap in my name and you'll find a way to get hold of me.
Cool. Awesome. And guys, do remember we did do a podcast a wee while ago now, so check it out. Link below the video so you get the full story from Steve. And there's a video in there as well, along with the other videos in this Q&A series. Do remember, hit subscribe, hit like, click on the notifications bell, click all, and we'll see you in the next video.